In this lecture, we focus on the income statement and farm profitability. We begin by defining the income statement and explaining how it connects to the balance sheet. Then we identify the major sources of farm revenue and the different type of farm expenses. We will distinguish between net farm income from operations and net farm income. Next, we calculate net farm income using both cash and accrual accounting methods. Finally, we analyze farm profitability using key financial ratios: return on assets, return on equity, and operating profit margin, and discuss the difference between maximizing profit and achieving true financial efficiency. The income statement measures the difference between revenue and expenses during an accounting period. Its primary purpose is to calculate net farm income. Unlike the balance sheet, which shows financial position at a single point in time, the income statement summarizes activity over a period, similar to a video recording of the year rather than a snapshot. The key question it answers is simple: did the business make a profit or a loss, and how large was it? The balance sheet shows where the business stands at the beginning and end of the year. The income statement explains what happened between those two dates. In other words, changes in equity on the balance sheet are explained by profits or losses reported on the income statement, along with owner withdrawals and contributions. These two statements must always be interpreted together. The income statement links directly to the balance sheet through changes in owner equity. If the farm earns positive net farm income and retain it in the business, owner equity increases. If losses occur or large withdrawals are made, equity declines. Understanding the relationship is essential for evaluating long-term financial health. Revenue recognition on the income statement includes all income earned during the period, whether it is received in cash or not. This includes cash sales, changes in inventory values, and changes in accounts receivable. Loans, gifts, inheritance, and non-farm income are excluded because they do not result from farm production. Capital gains and losses reflect differences between selling prices and book values of capital assets. When assets are traded, no gain or loss is recorded. The book value of the old asset plus cash paid becomes the cost of the new asset. Expenses include all cash and non-cash costs occurred to generate the revenue recognized during the period. Accrued expenses are included in the year they are incurred, even if payment occurs later. Prepaid expenses are deferred to the year they are actually used. Some cash outflows are not expenses. Loan principal payments simply return borrowed capital. Capital asset purchases are expected gradually through depreciation. Personal withdrawals for family living are not business expenses. Depreciation is a non-cash expense that reflects the loss in value of an asset over the time due to use, wear, age, and technological obsolescence. For an asset to be depreciable, it must have a useful life longer than 1 year. A determinable life and must be used in business. Land is not depreciated because it has an unlimited useful life. Under the straight line method, depreciation is spread evenly over the asset useful life. Each year, the same depreciation expense is recorded. This method is simple, predictable, and commonly used for financial analysis and record keeping. The declining balance method accelerates depreciation. Higher expenses are recorded in the early years of an asset's life, with smaller amounts later. This approach better reflects assets that lose value quickly when they are new. When comparing annual depreciation amounts, the declining balance method results in higher early year expenses, while the straight line method remains constant. The timing of depreciation affects reported profit, but not total depreciation. Although depreciation timing differs, both methods result in the same total depreciation over the asset's life. The difference lies only in how depreciation is allocated across years. Managers should focus on consistency and purpose when selecting a depreciation method. The income statement follows a structured format. Revenues are listed first, followed by operating expenses to calculate net farm income from operations. Gains and losses from asset sales may be included with revenue or listed separately, depending on analysis goals. Interest expense is shown separately because it is a financing cost rather than an operating cost. Cash accounting is simple but often misleading for management decisions. To obtain an accurate picture of profitability, managers should calculate accrual adjusted net farm income at year end. Accrual adjustments ensure revenues and expenses are matched to the correct production period. Revenue adjustment accounts for inventory and accounts receivable. Beginning inventories are subtracted to remove revenue from previous years. Ending inventories are added to recognize revenue from current year production not yet sold. This ensures that revenue reflects what was actually produced during the year. Unpaid expenses such as accounts payable and accrued expenses must also be adjusted. Beginning unpaid expenses are subtracted and ending unpaid expenses are added. This ensures expenses are recorded in the year they help generate income regardless of payment timing. Prepaid expenses require the opposite adjustment. Beginning prepaid expenses are added since they were used this year. Ending prepaid expenses are subtracted because they will be used in future periods. These final steps complete the accrual adjustment process. Return on assets measures how effectively the farm uses all assets, both borrowed and owned, to generate profit. Return on asset reflects operating efficiency and assets utilization, making it one of the most important profitability measures. Return on equity measures the return earned on the owner's invested capital. It is influenced by both operating performance and financial leverage. Operating efficiency, often measured through operating profit margin, explains how well revenues are converted into profit. Changes in owner equity result from net farm income, withdrawals, contributions, and asset value changes. Tracking equity over time reveals whether the business is truly building wealth or simply generating short-term profit. The statement of cash flows explains how the cash balance changed from the beginning to the end of the year. It separates operating, investing, and financing cash flows. This statement is essential because a business can be profitable yet still experience cash shortages. To summarize, the income statement measures profitability over a specific accounting period by organizing revenue and expenses. Depreciation is a critical non-cash expense that must be properly recorded. Because cash accounting can be misleading, accrual adjustments are essential for sound decision making. Profitability is evaluated using return on assets, return on equity, and operating profit margin. Finally, a complete financial analysis must include a statement of cash flows to distinguish accounting profit from actual cash availability.